Welcome to the session of REITs. Initially, back then before 1960, real estate investments are made manually and only big institutional owners could invest in these so-called high investments. So REITs were created in the United States after President Mr. Dwight signed Public Law 86779, sometimes called the Cigar Excise Tax Extension of 1960. The law was enacted to give all the investors the opportunity to invest in large-scale, diversified portfolios of income-producing real estate in the same way they typically invest in. REITs, for the first time, brought the benefits of commercial real estate investment to regular Americans that previously had been available only through large financial intermediaries and to wealthy individuals. The groundwork for the modern REIT era followed with the Tax Reform Act of 1986, when REITs were given the ability to operate and manage real estate rather than simply owning or financing it. The REIT approach to real estate investment has been refined and enhanced over the ensuing years. The original legislative intent was that REITs would be an inclusive approach that would allow all the Americans to enjoy the benefits of investing. A typical REIT structure works like this. Money is raised from unit holders through an initial public offering, that is an IPO, and used by the REIT to purchase a pool of real estate properties. These properties are then leased out to tenants. In return, the income flows back to the unit holders as income distributions. Most REITs have annual REIT manager's fee, property manager's fee, trustee's fee, and other expenses that will be deducted from their profits before distributions are made. Some REITs which hold properties in foreign jurisdictions may also be subjected to taxation by the relevant jurisdictions. Investors can find information on these fees in the REIT's prospectus and financial statements. A REIT structure typically has following key roles. A trustee. The trustee's duties are set out in the trust deed. The trustee is responsible for holding the assets of the REIT on behalf of unit holders. Other duties may include ensuring compliance with all applicable laws and protecting certain rights of unit holders. The trustee is paid a fee for providing this service. The REIT manager, the second one, sets and executes the strategic direction of the REIT according to its stated investment strategy. For instance, it is responsible for the acquisition and divestment of the REIT's properties. In an externally managed model, the REIT manager charges a management fee that includes a basic fee and performance fee in exchange for its services. It may also charge additional fees such as acquisition and divestment fee. A REIT manager typically appoints a property manager to manage the real estate properties of the REIT. The property manager's responsibility includes renting out the property to achieve the best tenancy mix and rental income. In return, the property manager is paid a property management fee out of the assets of the REIT. The third and one of the most important is the REIT sponsor. In some cases, there is a sponsor who sources the properties that are injected into the initial portfolio of the REIT and may continue to provide a pipeline of assets for the REITs. Usually, the sponsor also owns the stakes in the REIT manager and the REIT. Coming to the benefits of REITs, the first is the diversification. The risk arising from investing in one property is diluted when you invest in a pool of properties through a REIT. Second is the affordability. As an individual investor, you may not be able to afford a direct investment into a large asset such as office buildings or shopping malls. By investing in a REIT, you get to invest in these large assets in bit-sized chunks. Third is the liquidity. It is easier to buy and sell units in a REIT than to buy and sell properties. REITs are listed on the stock exchange and you can trade units in a REIT throughout the trading day. Tax benefits. REITs that distribute at least 90% of the taxable income each year enjoy tax transparency treatment by IRAS. Individual investors who receive these distributions also enjoy tax exemption treatment. Transparency and flexibility. You can access any information on REIT prices and trade REITs throughout the trading day. On the downside, REITs don't offer much in terms of capital appreciation. As a part of their structure, they must pay 90% of the income back to the investors. So, only 10% of the taxable income can be reinvested back into the REIT to buy new holdings. Other negatives are that REITs dividends are taxed as regular income and some REITs have high management and transaction fee. Other cons include low growth, dividends that are taxed as regular income, subjected to market risk, and finally potential for high management and transaction fee. Everything should have a regulation or else it would lead to another crisis. Jokes apart, coming to the regulations of REITs in India, the Securities and Exchange Board of India introduced the concept of REITs in India with an intent to provide the much needed capital to the real estate sector in 2014. The SEBI REITs regulations inter alia set out the registration requirements, procedure of registration and eligibility requirements of REITs. However, it is mandatory for units of all REITs to be listed on the recognized stock exchange having nationwide trading terminals, whether publicly issued or privately placed. This is a short intro about REITs. So, are you ready to invest in the REITs?